Welcome back. Gives me great pleasure to welcome on board our next guest, Raoul Pal, CEO and co-founder at Real Vision. Great to have you with us, Raoul. And after a while, looking forward to hearing how you're deciphering all that's going on currently. Now, last time when we spoke, and this was about a year ago, you had actually cautioned against a big event which could possibly turn the world upside down. And in 2020, that's exactly what has happened. Now, the pace of the fall and more importantly, the recovery has also come as a rude shock to many. And are you surprised at the pace at which the global markets, the pace and the manner in which the global markets have reacted?
Yeah, I think, look, everybody's surprised when we've had the biggest economic event of all of our lifetimes and the markets have basically shaken it off as a short-term thing. I think in some respects, it's to do with the flow of funds and how people invest. But it's also a belief that this was a short, sharp shock and something that's not lingering. And I'm not sure that's true.
Okay, so in your report a few months ago, you had described the three phases of the unfolding panic, hope, and insolvency. In your assessment, currently at this juncture, which phase are we in and what really is the road ahead?
I think we're transitioning from the hope phase into the insolvency phase. The hope phase is when everybody believes everything is going to be okay and the economic event, and in this case COVID, will go away relatively fast and things will return back to normal. The insolvency is another spin on this. And that's the fact that it seems that COVID's not going away and the economic event can drag on. We're seeing in Europe the signs of further lockdowns and economic restrictions. We will get the same in the United States. And in India itself, you know, even though the virus is starting to slow, things will continue longer and the economic disruption goes on longer. But in the investment world, what that leads to is a bifurcation. So companies that have plenty of cash flow, they're fine, but companies that don't, and that's what's happening right now, is year-on-year GDP growth is not recovering above zero and is unlikely to do so this year and maybe for a large part of next year. If that's the case, then companies that don't have access to capital markets, companies with higher debts, whether they're small companies or even households, start running into problems. Now, particularly when fiscal stimulus is fading somewhat around the world, it makes it dangerous. And it makes it dangerous because these companies start defaulting on their ability to pay their debts or go under. And that makes unemployment stickier. That in itself lowers demand and it drags on the economic episode longer than expected. And we can see that in many of the banking stocks around the world that have been very, very subdued, for example, versus the main indices, particularly the tech companies that have no debt and are all cash generative businesses and have been less hit in an online world than in a bricks and mortar world. So there is a big bifurcation that's already going on. We've seen it in also things like gold miners that at one point were outperforming the banks by 85% in the first 7 months of this year or 8 months of this year. I've never seen a bifurcation of that sort before, and it's giving me alarm signals. We also see it in the bond market. The bond market never really recovered. Yields stayed very low globally, and they don't seem to want to price in a big recovery. Now, the bond market I call the market of truth, because bonds tell the truth because really they're very macro. They're priced off inflation and GDP growth, and that's what they look at. And they're telling us things are not going to return back to normal for much longer than most people are expecting.
Sure. Raoul, how do you see the US elections playing out and the kind of impact that they would have on the markets? And what does one do in that case with the existing holdings? Buy, hold, or sell? Is there a blanket call or approach that could work here? I
am more cautious and I would reduce equity holdings right now. markets have come a long way, and I think it's now a prove me situation where we need to see some economic growth. In terms of the US election, I don't think it's necessarily a positive or negative impact on markets. I know people like to say, well, Democrats, well, because of taxes, it's worse. I do think tech companies probably come under closer scrutiny for regulation and potentially some higher taxes. But I think the markets already start trying to price in some of this, and we've seen some of these tech stocks not moving forwards for a while now. I think what is also interesting is, let's say it's a Democratic victory. Well, the marginal propensity for a Biden administration to undertake more kind of restrictive measures to get COVID under control is higher than the markets perceive. If that is the case, then we'll see what is happening in Europe repeated in the US, which is a slowdown of economic growth. And again, it's not a collapse, but it's a general slowdown, which drives into my insolvency thesis. Now, we do expect a stimulus package to come. I'm not sure they'll get one done before the election. And if not, maybe it doesn't come till January. So there's a big air pocket for markets that could be a little bit complicated. But really, I don't think the big fiscal stimulus comes till much later, once we've seen further economic weakness. It's very difficult for the Democrats to try and pass a big New Deal if we don't see much more economic weakness. And I think the same with let's say if Trump gets back in, well, we've seen that the Republicans are not super keen to do much more stimulus either. So I think overall, I think the markets could slow down after the election as people are in a wait and see mode in terms of stimulus, and the rise of COVID over the winter keeps economic growth subdued.
Right. Raoul, there's been sectoral rotation once, the cycle ends. This time it is from financials towards IT and healthcare. Which are the sunrise and sunset sectors in your view?
So I am more orientated to be underweight things like banks right now because of solvency. So anything with debts, I don't like. I understand that they have massively underperformed the market, and the risk is that my view would be wrong, and in which case those would play catch up. But I don't yet think that that is the case. I think the insolvency event is larger than that. I do like things like gold miners, precious metals, cryptocurrencies, things that, we're seeing more and more printing of money by the governments and central banks and more stimulus. And so I think those kind of hard assets will tend to do well over time. Things like the gold miners, they've traded sideways for an extended period now and have been correcting. So I would imagine that they would be good performers again going into the end of the year and into next year. So I kind of like that sector. I know many people are looking at the commodity sector overall, but again, I'm not a big believer in a global cyclical pickup yet. I think that comes later, and this may be a false dawn. So, tech stocks themselves, I'm not entirely comfortable with. I understand the arguments, but they're very, very expensive. There's a lot of speculation in the names. So I'd rather be underweighting those and underweighting the markets in general.
Now, you'd also predicted oil going to zero. That's actually exactly what happened. In fact, negative. We saw worse. You've also maintained that the bond market tells you, the future outcomes, commodities tell you the present. So if we go by that, what are they whispering to you now?
Well, the bond market is telling us, as I said before, that things are not good, but they're not deteriorating yet. If anybody wants to watch anything, that's easy to watch, you can use, well, even the Indian bond market, or you can use the TLT in the US as the ETF. Once you start seeing that breaking higher above 170, then it's telling us things have changed. My personal opinion is that interest rates in the United States are going to go negative. So I think that we have another move in the bond market to come as the market starts to realize that economic growth is not coming back as fast as they'd like it to, and that economic stimulus is a false economic hope in terms of the effect it will have on the economy. So I'm waiting for that signal. I'm waiting to see two-year rates go negative. Don't forget, we've just seen that happen in the United Kingdom for the first time in the history of the UK bond market that goes back some 300 years. rates have gone negative and the Bank of England look like they'll follow. Most of Europe is now negative. Denmark, Sweden, Switzerland, they're all negative. We've seen New Zealand flirt with negative rates, and I think we'll see that overall. For those Indian investors, I still think the Indian bond market offers opportunities. You know, it offers a decent yield, and I think over time, bond yields will drift lower in India. So the asset allocation I prefer is heavier weighted towards bonds than equities. Also of note is that the speculator short position in 30-year bonds in the US is an all-time record. People are heavily betting on rates rising. And when everybody's on one side of the boat, it's often better to explore the other side of the boat for better returns.
Raoul, request you to just stay on with us. I wanted to take cognizance of the flashes that are coming at the bottom of your screens. Do remember that Walmart owned Flipkart as well as e-commerce major Amazon have been in separate talks with Aditya Birla Fashion and Retail for a potential investment, and now it seems like the deal has been sealed. Aditya Birla Fashion and Flipkart have signed that landmark pact where Aditya Birla is going to raise 1,500 crore rupees from Flipkart, and this is for an equity of Flipkart Group owning 7.8% in the Aditya Birla Fashion Retail Group. The Aditya Birla Fashion is going to make a preferential payment to Flipkart and raise equity capital at a price point of 205 rupees per share. Now, do remember, this is coming at a time when you have seen the retail space as well that has been severely hurt by the coronavirus pandemic and, of course, the lockdown. So brands like Pantaloon, Allen Solly, Peter England, etc., that is what Aditya Birla Fashion currently owns. And that's the latest with respect to the deal with Flipkart being sealed. 205 rupees per share, so that's at a premium to what it's currently trading at, 154. The stock has spiked up. Well, let's get right back to our conversation. Raoul, apologies for that interruption. And, you know, since the last conversation that you had with the channel, everything has really played out according to script except for the dollar as well as the Bitcoin. Are you still convinced, though, that the dollar is king and that the world needs Bitcoin?
I think that the dollar is, you know, it's been stuck now for months and months and months in a sideways range. I still think the dollar strength pattern is in, but let's wait and see. Price will be the final arbiter of the truth within that. I think if it's a debt cycle, then most debt is denominated in dollars, and that tends to drive the dollar higher. If I'm wrong and we are back to growth, then the dollar will weaken over time. Bitcoin, well, that has been going up. It's been going up a lot since I suggested it, and I think it will continue to rise because in inflation and deflation, Bitcoin rises. In inflation, it rises because the value of hard assets goes up. In deflation, it rises because the only answer the central banks and the governments have is to do more, and that tends to weaken currencies. And overall, that makes Bitcoin very attractive. You know, Bitcoin is the hardest asset that there is. It has a fixed supply, and that supply eventually runs out. So it's a truly extraordinary opportunity if you're able to own it.
Well, that's an interesting view. So continuing to hold your ground there when it comes to Bitcoin. But at what point do you think this thesis needs to be revisited?
Yes, I mean, the dollar's only part of the thesis, but I must admit it is a large part of the thesis. So, you know, I would say that I wouldn't be comfortable seeing the DXY, the dollar index, you know, below 90. That would make me start to change my view. Now, don't forget, I have long-term views, and the dollar view, I've been long the dollar for almost a decade now. So it's been a very, very long-term and very good trade for me. But, you know, I acknowledge things could be changing, and I'm always open to changing my opinion. If the dollar does change, well, that offers up lots of opportunities like emerging markets. If the dollar starts falling, then emerging markets do particularly well. So countries like India will be net beneficiaries. And that sets us up with lots of investment opportunities. Right here and right now, with the dollar trading sideways, those opportunities are less clear.
So much for joining us. Always great chatting with you, and look forward to hearing how things unfold, hearing and seeing how things unfold over the next few months.